volume of exchange shares daily, 2.69 million. Hence, the conclusion here is easy. SCHD is clearly the winner. The bonds. Before we dive into this, it is important to note several points. First, what are bonds? Bonds are financial instruments that represent a form of debt. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments, the coupon, and the return of the bond's face value, also known as its principal, at a specified future date, known as the maturity date. Bonds are commonly used by governments, municipalities, corporations, and other entities to raise capital for various purposes. Bonds can be bought and sold in the secondary market before their maturity date. The market price of a bond may be different from its face value and is influenced by factors such as changes in interest rates, credit quality, and market demand. Some bonds are callable, meaning the issuer has the option to repay the bond before its maturity date. This feature can affect the bond's price and potential returns. Bonds are considered less risky than stocks, as they provide a more predictable stream of income based on regular interest payments at fixed intervals, which are predetermined at the time of purchase. However, they come with their own set of risks, primarily related to interest rate changes and credit risk. The risk that the issuer of the bond may default on its payments. Interest rate increases can lead to a decrease in the value of existing bonds, potentially impacting their resale value. Stocks, on the other hand, offer the potential for capital appreciation over the long term, but they also carry higher market volatility and uncertainty. In the Vanguard Total Bond Market Index, with the ticker BND offered by Vanguard. The BND ETF seeks to track the performance of the Bloomberg Barclays U.S. Aggregate Float-Adjusted Index, which includes a wide range of U.S. government, corporate, and mortgage-backed bonds. 2. The iShares 20-plus year Treasury Bond ETF, or TLT. This ETF tracks the performance of the ICE U.S. Treasury 20-plus year bond index. This index consists of U.S. Treasury bonds with maturities greater than 20 years, long-term, and is managed by BlackRock. These bonds are usually considered to be among the safest investments available because they are backed by the U.S. government. 3. The Schwab Intermediate Term U.S. Treasury ETF, with ticker SCHR. This ETF is offered by Charles Schwab and is designed to track the performance of the Bloomberg Barclays U.S. Treasury 3 to 10 year bond index. It provides investors with exposure to U.S. Treasury bonds with maturities ranging from 3 to 10 years. Let's compare the performance of the three ETFs over the last 10 years. As you can see, there is a huge volatility of the TLT ETF and an average annual growth of below or around 1%. Which is really low compared to stock-based ETFs analyzed before, and the max drawdown is minus 41%. The best choice is clearly BND, with the highest market cap, almost $95 billion, the highest performance, although very low, the highest diversification, with almost 18,000 holdings. As you might have understood, I am not a fan of bond-based ETFs. However, it's essential to consider your overall investment goals and risk tolerance, and a well-diversified portfolio may include a mix of both asset classes to achieve a balanced investment strategy and cover all market conditions. Another way to potentially diversify your portfolio without directly purchasing and managing physical real estate properties is to buy an ETF composed of real estate assets. So let's explore the following ETFs. 1. The Vanguard Real Estate ETF, or VNQ. This ETF is managed by Vanguard Group and is designed to track the performance of the MSCI US Investable Market Real Estate 2550 Index. The ETF primarily invests in real estate investment trusts, REITs, which are companies that own or finance income-producing real estate across various sectors, such as residential, commercial, and industrial properties. VNQ typically pays dividends to its investors, making it attractive if you are an income-oriented investor. 2. The iShares US Real Estate ETF with the ticker IYR. This ETF is designed to track the performance of the Dow Jones US Real Estate Capped Index. It allows you to gain exposure to a diversified portfolio of U.S. real estate assets, including real estate investment trusts and other real estate-related companies. 3. The Schwab U.S. REIT ETF, with the ticker symbol SCHH. It is managed by Charles Schwab Investment Management. It tracks the performance of the Dow Jones Equity U.S. All REIT Capped Index, which gauges the performance of publicly traded real estate investment trusts, REITs, in the United States. The ETF's portfolio would typically include holdings from various sectors such as residential, retail, office, industrial, and more. The performance of these ETFs is subject to the risks associated with real estate, such as changes in property values, interest rates, and market demand. Let's first examine and compare the performance of these ETFs over the last 10 years. If you had invested $10,000 in 2013 and reinvested the dividends, you would now have roughly $19,000 with both VNQ and IYR, and only about $16,500 with SCHH. This represents an average annual growth of about 6% for the first two ETFs and 4.8% for the third one, with a max drawdown of minus 29% for the VNQ and IYR and minus 30% for SCHH. Hence, VNQ seems to be the best. This is confirmed by the other criteria we discussed. VNQ appears to have the highest market cap with almost $32 billion, the highest dividend yield with 4.66%, while the other two are only slightly above 3%, and the second highest liquidity with 4.39 million shares exchanged daily, corresponding to $356 million. Hence, the winner is clearly VNQ. Now, to give an overview of our conclusions, we will compare the podium top ETF of each class we studied. These are VTI for total U.S. market, IEFA for global market excluding U.S., VOO for S&P 500 tracking, SCHD for high dividend paying ETFs, BND for bonds ETF, and VNQ for real estate. Here is the performance graph comparison of the performance of these ETFs. The three ETFs based on U.S. stocks, VTI, VOO, and SCHD, show the highest performance of about 13%, with slightly better results for VOO and similar max drawdown data for all three, slightly above 20%. Then come the global and real estate ETFs, IEFA and VNQ, with around 6% average annual growth, slightly better for VNQ, but with max drawdowns higher than those of the U.S. market ETFs, about 29%, despite a lower performance. And then the bond ETF, BND, with only about 1% average annual growth, less than inflation, with a max drawdown of 17%. However, if one considers the other criteria, especially dividend yield and expense ratio, the ranking is very different. The highest dividends are paid by VNQ, real estate, with 4.66%, but also the highest expense ratio of 0.12%. Then comes SCHD with 3.53%. This seems logical as it is the dividend-designed ETF. The expense ratio is 0.06%, half that of VNQ for only 1.3 times lower dividends. The third on the dividend podium is BND, the bond ETF, with 2.99% and only 0.03% expense ratio, a fourth of VNQ, for 1.5 times lower dividends. Then comes IEFA, the global market ETF, with 2.44% dividend yield and a relatively high expense ratio of 0.07%. And only then comes VTI and VOO, the U.S. market ETFs, which were the winners of the performance criteria. All these ETFs have high market cap and high liquidity, so there shouldn't be any concerns on those aspects. Hence, the choice really depends on you, what you expect most, dividends or long-term performance, and if you prefer to invest only on the U.S. stock market or diversify more with real estate, bonds, or global stock market. But whichever way, I highly recommend investing in ETFs. If you want an even better performance with a lower drawdown, you can also copy my portfolio. Let's compare the results of my portfolio with the two best performing ETFs we just analyzed, VTI and VOO, since 2016. The two ETFs have a performance of about 17% per year, while my portfolio shows an average annual growth rate of more than 22%. But maybe you think, yes, okay, but this is with very high volatility. Nope. The max drawdown of the two ETFs is around minus 20%, while that of my portfolio is around minus 15% only, almost 5% less than those of the two ETFs. And this is without taking into account my secret booster. If we now compare the performance with that secret booster since 2016, the average annual growth is almost 30%, with only a slightly higher drawdown, minus 15.74% instead of minus 15.39% without that booster. So it's entirely up to you and your strategy. You can either buy ETFs and spend time only when you buy them, or dedicate a few minutes per month to your investments, as my portfolio is updated every month and have a better performance. But take good care of your money. If you do nothing, you lose daily, just because of inflation. If you liked this video, feel free to watch this one, which is complimentary. Thanks for watching. Goodbye. You want to establish a prosperous online business, but do not know where to start? The journey becomes smoother with the right tools and techniques in your arsenal. In this video, I'll walk you through a systematic approach to building an online business and the must-have tools that can facilitate each step of the journey to establish a thriving online venture. First step: attracting prospects with landing pages and funnels. Attracting prospects, the lifeblood of any online venture, is paramount, starting with the landing page, the first impression that counts. These pages are laser focused to prompt one action, driving towards the ultimate goal: conversion. The funnel encapsulates this journey. ActiveCampaign, a powerful tool for personal and impactful audience communication. Once you have their attention, the next step is engagement. This means keeping your audience interested and, more importantly, keeping your business at the forefront of their minds. The way to do this is social media management. Social media management is essential for your online business to boost your visibility, customer engagement, and growth. Key practices include maintaining an active presence to increase brand awareness, engaging with customers to foster trust and loyalty, gathering immediate feedback for product or service enhancement, driving more traffic to your website or platform. Effective social media management involves crafting content that appeals to your audience, timing your posts for maximum